2026, 2027 is the danger zone. Now, is this an opportunity? Absolutely. This is why we are buying a lot right now. We're finding great opportunities. A lot of it is in distressed, paying low cost, and seller financing. These are opportunities that just don't come around when money's cheap. So these are generational opportunities. The debt markets and the institutions are telling us what we should expect over the next few years, particularly this year and next year. It will be the years of opportunity. There is a lot of risk in commercial real estate right now. We're going to look specifically at storage, but it is the same for all commercial real estate. Now, we are going to look at exactly what the bond market and institutions are telling us is going to happen over the next 3 years, but not just telling us. We're going to take a look at Public Storage, Extra Space, and see how they are positioning and what they're doing currently due to what they see and what's happening right now over the next 3 years. By looking at the institutional players and the bond market, we can see exactly what the market is saying is going to happen. This tells us where you need to position, where the risk is, also where the opportunity is. So whether you're looking at getting in storage, whether you are a self-storage operator with one facility or 100, these are the most important things you need to be looking at right now. First up, let's just directly look at the institutions. Public Storage, Extra Space, and the rest of them. They are all executing on a 3-part playbook. And it literally tells us everything that we need to know and understand about the next 3 years in self-storage. The first step is they are locking in fixed rates, long duration at today's rates. So I got the numbers. Let's look, for example, Public Storage. So Public Storage at the end of the fourth quarter in 2025, their weighted average interest rate was 3.2% that they were paying. So 3.2%. That was across $10.3 billion of debt on a weighted average of 6.3 years till maturity. Now, in early April, they priced $500 million offering at 5% senior notes due 2035. This is the largest, most sophisticated operator with Extra Space in the world, and they're paying 5% for 10-year fixed debt today rather than waiting for rates to come down. That is probably the most important signal that we're seeing. Now, this goes right along with, if you haven't listened or saw my video, the other podcast on 2030, what's going on there, right align with what I'm talking about with that economist. Because note, they locked it in till 2035. Step 2, they're hedging their variable rate exposure to near 100% effective fixed. So Extra Space Storage percentage of fixed rate debt is 82%. That's a big number. Now, net of the impact of their variable rate receivables and interest rate hedges, the effective fixed rate debt total is 92%. So we see both in Public Storage and Extra Spaces what they're doing today in both of these steps. They're locking in. They are not waiting for rates cuts to come to bail them out or to lock in. They're actually locking in 10 years and they're getting rid of the exposure to variable rates. So both of these institutions are making big moves right now to get rid of variable rates, lock in for long-term 10-year fixed, even at today's rates. That's very clear on those assumptions. They're not expecting rates to come down. At least they are not actually doing anything remotely that would tell you that. Now, step 3. This is the interesting one. There's been a major shift by institutional players to lend to operators privately. particularly in distress. So Public Storage originated $48 million of bridge loan financings for third-party storage operators in the fourth quarter of 2025 alone. The average rate there was 7.7%. Now, I'm going to take a break here just to clarify a few things. We're talking about debt and the interest rates and what they are locking in their debt for, their expectation of what they should be paying. Now, this is important because in commercial real estate, cap rates track interest rates largely. They're kind of in line with them, right? So if interest rates go up, values go down. That means cap rates go up. If values go down, cap rates go up. That is really important to understand a few things. First of all, the risk, where it lies, what the expectation is, but also valuations and what we are expected to see. Right now, Public Storage total notes receivable that are on their books is $142.1 million at an average interest rate of 7.9. They are simultaneously borrowing at 5% while they're lending at 7.7, bridged to distressed operators. So they're lending at 5, they've locked in, they've got this debt at 5. They're then giving bridge debt to operators at 7.7. Now, these are usually operators that are in distress. Now, this is important because that's a 270-point basis spread that is captured on the back of private operators in distress. Now, where have we seen this before? This is where it gets really interesting because this is the same playbook that we saw JP Morgan and Berkshire Hathaway do during the 1970s. The institutions become the lender of these distressed operations, these distressed properties. Then what happens? They become the buyer. So what I'm saying is they're positioning themselves locked in for the long term. They're lending more short term at a higher rate to distressed properties, and that becomes their deal funnel. So they're creating opportunities for themselves. They'll be then able to come in and take over and now own these distressed properties. Now, how the distressed operators would avoid this is by being able to refinance. But in step one, we already saw the expectations of these institutions. They don't expect to be able to refinance lower than what they are locking in today and giving out. And these are major institutions. So that shows what they expect the market to look like for the operators in which they're lending money to during that same period of time.
All right, since I know my listeners are self-storage nerds just like me, I wanted to share with you some of the best ways that you can get started investing and owning self-storage. So you may not know, but I wrote a book that's hard to even call this a book. I mean, this is a manual. We're talking 400 plus pages, which include all sorts of information about how we have been in the self-storage industry. That's everything from how we got our first deals, to scaling, to buying deals in today's market, what's changed and what remains the same. This is an up-to-date book that shows you how the market has changed and how you can win today. This isn't simple, this is how you buy a deal. No, this goes into everything, including how you scale and create a self-storage business. You can get a physical copy, an ebook, or the audiobook, plus free access to bonus content at the end of each chapter. You can get it today. It's available on Amazon and other platforms in which you can follow the link.
Okay, so now what are the institutions looking at that are telling them this is happening? Now that moves over to our second area of focus. The institutions are currently looking at the bond market, and the bond market is being really clear where the risks and the expectations over the next 3 years are. Over the last 6 months, the yield curve changed, and not in a way that we would like to see. Now, remember, the yield curve simply represents the bond market, so where government bonds are selling and the interest rate at which each bond is getting, depending on the duration of time. So you have short-term, 3 months, 2 years, 10-year, and 30-year. Now, for commercial real estate, self-storage, the 10-year is really important. But the yield curve overall is very important to understand the short-term expectations, not just that 10-year out. The yield curve is what shows us when we're going into recessions, for example. The yield curve goes from left to right, meaning that the short-term yields on bond notes are lower than the yields or that interest rates on longer-term notes. So if you look at the interest rate, it makes a slope from left to right up. Short-term, lower, long-term, higher. When that gets inverted or flattens, we see recessions. It also tells us what money is doing and debt is doing in the market. Now, that is what these institutions are looking at. And what we've seen in the last 6 months is the 2-year, so it's kind of that bottom middle of that curve, has gone up. That starts to flatten that line out. That's not a good thing. A healthy yield curve goes left to right, slopes up. What we're seeing is that in the last 6 months, that 2-year has gone up, the 10-year has gone up, and the 30-year have gone up. So 2-year, 10-year, 30-year. It's gotten flatter. That's not a good thing. Now, why haven't these interest rates gone down and been acting like a normal yield curve in a good market, but instead signaling something more like economic pressures and stagnation or even a recession? Why it's changing towards that direction is simple. There's 2 driving forces. We have inflation as well as government debt. These 2 things combined are creating higher interest rates. Now, you may say, but the Fed's going to cut rates. Just because the Fed cuts rates doesn't mean that the market accepts it. And that's what we've seen. The Fed may cut rates, but then those bonds have to actually sell. When nobody wants to buy the bonds, interest rates have to go up to entice people to buy them. To buy so they get paid more, right? More risk, I want to get paid more. So then interest rates in the market can actually go up. What it's showing is that there's more risk in the short term. And that's really key and tells us a lot about what the institutions are currently doing, and it aligns directly with them. These 2 things together, side by side, are creating a path, a very clear path of the next 3 years. That path states we don't believe interest rates are going to come down and nothing meaningful. The amount of government debt plus inflation that's out there, it kind of makes the Fed stuck, and the market is not accepting it. Now, what does this mean for cap rates or value and risk? Now, this is the most important thing because what we're seeing today, you can go all the way back to really 2000, and we have not seen. And that is the spread between the cost of debt and cap rates or value is very tight, the tightest that it's been. Right now, we see an average cap rate of 6.4, but the current 10-year is 4.56, just about 5. That's a 200 basis point spread. That's it. Basically, the market is pricing in that either cap rates are going to go up more or rates have to go lower to get us to a normal historic spread in value to the cost of debt. Now, once again, the market needs cap rates to go up or interest rates to go down. But the bond market, as well as the institutions, are not planning on that, and it doesn't look like that over the next 3 years. So, in turn, that really tells us that values on storage, the cap rates, are going to remain higher most likely, while values remain most likely lower. Now, I'm talking about market value. I'm not talking about the rental rates or anything else like that. I'm not talking about net income getting better, right? All of those things can happen. So the actual amount of your facility's worth goes up. But I'm talking about what people can borrow at to pay for that facility, that effective cap rate. We have to remember that cap rates and interest rates follow each other. So when interest rates go up, cap rates go up, meaning values go down. When interest rates go down, cap rates go down, meaning values go up. Why? Simple. Because if I can borrow at a lower rate, I can pay more to maintain the same cash flow. When I can't borrow, or I have to borrow at a higher rate, I have to pay less to maintain the same cash flow. Now, this is combined with the fact that today most prices are below replacement cost in most markets. So that's a real problem for new supply coming on. Now, that's really good because that means less new supply, there's less options, more demand, and rents can go higher. That's a really good thing, especially when it comes to value. So it also shows us that over the next 3 years, we are likely to be a supply-constrained market outside select markets where the value justifies it. All right, so what do these two signals, these two main things mean for investors? Like, what decision should you be making from these? What should we take out of it? This is the important question. Really, it depends on a couple things. Are you buying? Are you refinancing? All right. First, let's start with refinancing. What you need to do, take your current NOI, divide it by your loan balance. If your debt yield is below 8%, you have a refinance gap problem. If it's below 10%, you have very little cushion. Then run that debt coverage ratio at 7% interest. If it doesn't cover it at 1.25x, you're going to have an issue on the refinancing. There may need to be cash to the table or a restructure. So if you're refinancing, we have a baseline here over the next 3 years that you should be looking at and planning on. Now, the question is, if you're refinancing or you're buying, should I lock in rates now, get a floating rate, or should I wait for lower rates? My simple answer is lock in now, because we're not seeing anything that is telling us in the bond market or by the institutions that interest rates are necessarily going to go lower. Public storage is locking in for 10 years at today's rates. Now, will cap rates go down, meaning will values go up? Probably, but it's going to be slow. What needs to happen? We need that 10-year to go down. We need people to be able to borrow at lower amounts. And NOI growth needs to resume. Now, NOI, I believe that's going to get better. So we have a supply constraint issue for most markets. Demand has maintained stable over the last 6 months. We've seen occupancy and rates bounce back and rates begin to increase. And I believe that will continue over the next 3 years simply due to supply-demand issues. Now, the overall debt side of things, that I don't nearly have as rosy of an outlook because that's not what the market's telling us. That's not what institutions are telling us. So although I do think rates will come down, I don't think it's going to be quick nor meaningful. And I don't think you should necessarily plan on it. So with that in mind, we look at it and say you should lock in rates and the expectations of simply financing at a lower rate. Now, if you need that property to go up, you've got to make that up in NOI growth. Now, to place debt, that value needs to rise. Once again, we're going to get that from NOI growth. We're not going to get that from the market, meaning do not depend on the market to make your facility more valuable. That has to come through operations and NOI growth. Your danger zone, 2026, 2027 is the danger zone for loans that are maturing. Floating rate and bridge debt, that's a danger zone. And then markets that continue to have supply pressure, particularly in the Sun Belt, those are danger zones because of the overall effect on NOI. Now, is this an opportunity? Absolutely. That is one of the biggest things you need to take away from this. The reason why the institutions are issuing debt is because of the opportunity. They're locking in debt to take advantage of the opportunity. Why? Because although cap rates being higher isn't really good if you own a facility, if you're looking to buy them, that's great. So there will be great buying opportunities probably continually for the next 2 years, where prices are coming down, or at least they stay down, and you can maintain a spread over interest rate while getting value add opportunity with future NOI growth. That's wealth creation, real wealth. Then when interest rates come down eventually, that's market value and wealth created. Those two things combined create a lot of wealth. But you do have to be careful. The same as when there's any opportunities, it's because the market isn't clear or it's a little lopsided, just conditions aren't really good. When conditions are great, there's very little opportunities. It's all market given. You need the market to go up. And if the market doesn't, that opportunity won't be fully realized. This is why we are buying a lot right now. And we're finding great opportunities. A lot of it is in distressed, but paying low cost and seller financing. These are opportunities that just don't come around when money's cheap. You pay premiums. So these are generational opportunities. That comes, though, with good planning, protecting your downside, watching out for new supply, locking in your debt. Once again, the debt markets and the institutions are telling us what we should expect over the next few years, particularly this year and next year. It will be the years of opportunity. The value creation will come through NOI growth, not market given. The danger zones are in refinancing short-term and floating rate debt. As long as you are understanding what the market is telling us, what you should expect, you can capitalize on opportunities that hindsight look incredible, while at the same time you're watching out for the downside. This will be the same across every asset class in commercial real estate for the foreseeable future, especially as that yield curve continues to flatten. There are huge problems in the debt market because they're not things that can go away quick. Government debt and the inflationary pressure that we face are not waved away by magic wands. These things take time. So the danger lies in the things that are being affected by that. So watch out, plan accordingly, and take advantage of the opportunities.